In 1998, a team of Nobel Prize-winning economists managed to lose $4.6 billion in a matter of weeks. They had the most sophisticated models on Wall Street. They had PhDs and decades of experience. But they skipped a few basic questions that any beginner with a simple checklist would have caught. Today, I want to show you the single most underrated tool in investing, and it has nothing to do with math. Welcome back to the Daily Investor. In 2009, a surgeon named Atul Gawande published a book called the Checklist Manifesto. He showed that in operating rooms around the world, simple checklists reduced surgical deaths by 47%. Pilots have used them since 1935. Construction managers swear by them. But most investors, even professionals managing billions, operate without one. Today, I am going to show you why a checklist is the most powerful risk management tool you will ever use, how Warren Buffett and Charlie Munger have used one for decades, and the exact framework you can build for yourself. This is not complicated. That is the whole point. Let me take you back to October 30, 1935. The United States Army Air Corps held a flight competition at Wright Field in Dayton, Ohio. Boeing entered their Model 299, a massive four-engine bomber that was so advanced it was called the Flying Fortress. Everyone expected Boeing to win easily. On its evaluation flight, the plane taxied down the runway, lifted off, climbed to about 300 feet, stalled, and crashed. 2 of the 5 crew members died, including the pilot, Major Ployer Peter Hill. The investigation found nothing wrong with the airplane. The problem was human error. The Model 299 was so much more complex than previous aircraft that the pilot simply forgot to release a gust lock on the elevator controls. A basic step, but in the pressure of the moment, it was missed. Boeing's response was not to simplify the plane. Instead, they created something that had never existed before, a pilot's checklist. A simple, step-by-step list of actions to complete before takeoff, during flight, and before landing. That checklist turned the Model 299 into the B-17 bomber, one of the most successful aircraft in history. The Army ordered nearly 13,000 of them. Here is the investing lesson. The stock market is a complex system, just like a four-engine bomber. There are financial statements, competitive dynamics, management quality, macroeconomic factors, and your own emotions all interacting at once. No one can hold all of that in their head reliably. The investors who think they can are the ones who crash. Let me show you 3 real disasters where a basic checklist would have saved investors billions. First, Enron in 2001. At its peak, Enron was the 7th largest company in America with a market cap of about $70 billion. Wall Street analysts loved it. But here is what a simple checklist would have flagged. Enron reported huge earnings, but its operating cash flow was negative or barely positive for years. A single checklist item, does reported earnings match actual cash flow, would have raised the alarm. When Enron filed for bankruptcy in December 2001, shareholders lost roughly $74 billion in value. Second, long-term capital management in 1998. LTCM was run by 2 Nobel laureates, Myron Scholes and Robert Merton, along with a team of PhDs and former Fed officials. Their models were brilliant. But they leveraged the fund to over 25-to-1 at its peak. A basic checklist question, what happens if our models are wrong and we cannot exit positions, was never seriously addressed. When the Russian debt crisis hit in August 1998, LTCM lost $4.6 billion in less than 4 months and required a $3.6 billion bailout organized by the Federal Reserve to prevent a wider financial meltdown. Third, Valeant Pharmaceuticals from 2015 to 2016. Hedge fund manager Bill Ackman invested roughly $4 billion in Valeant through his fund Pershing Square. The stock went from around $257 per share in August 2015 to under $30 by June 2016. Basic checklist items like is revenue growth sustainable without acquisitions, are accounting practices transparent, and is the company under regulatory scrutiny were all flashing red. Ackman eventually sold his entire position at a massive loss. These are not obscure examples. These were some of the most sophisticated investors and companies in the world. They did not fail because they lacked intelligence. They failed because they skipped basic steps. Warren Buffett does not carry a laminated card in his pocket, but make no mistake, he operates from a checklist every single time he evaluates a business. He has described his criteria publicly for decades, and they have barely changed since the 1970s. Buffett's checklist comes down to 4 core questions. 1. Do I understand this business and how it makes money? 2. Does it have a durable competitive advantage, what he calls a moat? 3. Is it run by honest and competent management? 4. Is it available at a price that gives me a margin of safety? If any one of those 4 answers is no, Buffett walks away. It does not matter how exciting the opportunity looks. This is why Buffett sat out the entire dot-com boom of the late 1990s. Technology stocks did not pass item 1 on his checklist. He did not understand the business models. So he did nothing while the market called him washed up. When the Nasdaq crashed 78% from its peak in March 2000 to its trough in October 2002, Buffett's Berkshire Hathaway held steady. Charlie Munger added another layer. He famously said, "Invert, always invert." Instead of just asking what makes a great investment, Munger asks what would destroy this investment. His checklist includes items like, what is the worst-case scenario, what do I not know about this business, and how could management be misleading me? Now, investor Monish Pabrai took this concept even further. After reading Gawanda's book, Pabrai built a detailed investing checklist with over 80 items, grouped into categories like leverage risk, management quality, moat durability, and valuation. He has talked publicly about how this checklist has saved him from numerous bad investments. The key insight Pabrai shares is that every item on his checklist came from a real mistake, either his own or someone else's. The checklist is a library of failures encoded as prevention. You do not need 80 items. You can start with 10. The important thing is that every item earns its place because it addresses a real, common mistake. Here is a starter framework. Before buying any stock, answer these questions. Notice that items 8 and 9 are not about financial analysis at all. They are about your own psychology. That is by design. Gawanda found that the best checklists address both technical steps and communication or judgment checks. In investing, your biggest enemy is usually not bad data. It is your own emotions. Let me show you why this matters with real numbers. Dalbar, a financial research firm, has published data for decades showing that the average equity fund investor earned roughly 6.8% annually over the past 30 years while the S&P 500 returned about 10.2%. That gap is almost entirely explained by emotional decision-making. Buying high on excitement, selling low on fear, and chasing whatever performed well last year. A checklist will not make that gap disappear entirely, but it creates a pause between impulse and action. That pause is worth a fortune over a lifetime. Here is the principle I want you to take away today. Investing is not a game of brilliance. It is a game of consistency and error avoidance. The checklist is the simplest, most effective tool ever invented for exactly that purpose. Surgeons use them to save lives. Pilots use them to land safely. And the greatest investors in history use them, whether they call it a checklist or not, to protect their capital and make better decisions. As Charlie Munger put it, it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. That is the checklist philosophy in one sentence. You do not need to be the smartest investor in the room. You just need to stop making avoidable mistakes. This is educational content, not financial advice. Always do your own research and consult a qualified financial advisor before making investment decisions. If this changed how you think about your investing process, hit subscribe. I put out a new video every single day on value investing principles that have stood the test of time. I have a question for you in the comments. What is the number 1 item on your personal investing checklist? I want to hear what matters most to you. Tomorrow, we are going to look at how to actually calculate intrinsic value step by step, so make sure you do not miss that one. Until then, invest wisely.